Good morning. Welcome to another Mindset Meets Mechanics. And we're going to look at more portfolios than what we normally do here. Real world portfolios where there's real money being invested into Spicer Investor. And Dave's going to join me today because of item number 2 on the agenda, which is the LTTP, public portfolios. And we'll talk about the acronym and all that when we get to it. And we'll have a look at recent closes. And if we get some time, we might look at some of the trades that have been running for longer in terms of what we call the leaps. So, and then we can have a Q&A. But before we do that, have to tell you that everything we cover here today is general investment advice, and none of it is specific or personal investment advice. Okay, where we normally start off with is what has been going on in the markets currently. And there's a stark difference between how the US markets are being traveling and how the Australian market has been traveling. And that tells you that, and what I've done just to get some relative performance here is I've taken this back to the previous high. So that goes back to 2021. So we're talking about a 3.5-year period here. And you can see the S&P 500 where the dotted profit loss line is, has risen from that last high back then by 26.63% to yesterday's close. And if we compare that, and obviously the breakout into a new high, new all-time high, and it's continued to travel. And that is the relative performance of the ASX, the All Ordinaries. I could have taken it back to that first high that it made on the left over here, but it's much the same. That, in contrast, has risen nearly 8%, so nearly a third since from that time. And you can see the breakout has been probably, let's call it putrid relative to the US market. And I've kept the relative strength chart over here. Okay, you can see this declining relative comparative strength is that showing that the All Ordinaries bottom chart is underperforming, because that blue line underperforming the S&P 500. That's the relative strength chart between the All Ords and the S&P 500. So it's no secret then as to why the All Ordinaries or the ASX portfolios have underperformed the US, and that is just because of environment, which has made it more challenging for the ASX. But we'll talk a little bit about that in a moment. Right, what we do here is there's 3 portfolios that I'm going to cover, which I've covered in previous sessions. And what we're doing here, what are our objectives, is to look at warts and all, real world conditions, up and down, sideways, drawdown, new highs, everything that happens on this journey called active investing or trading. And also with talking about not just timing, but also money management. And we'll be talking more about that in coming sessions of this session, the portfolio considerations. We will focus a little bit more on leverage in the coming months. And the whole idea here is how do we do executing under pressure with money at stake. And you would have seen in a lot of our stuff we cover is flawlessly executing, in inverted commas, because that's the term that Mark Douglas used, and all of our members that have attended, some 100 or more, that have Dave's been taking through the LTTP, which we'll talk about in a moment, and the portfolios that we're going to put here. There's been a lot of discussion about that. The other portfolios we're going to cover, I'll let Dave explain.
Yeah, so we're going to have a look at the Learn to Trade portfolio. So one way to think of this is that these are just another version of a public portfolio, if you like, but these are public portfolios that not one person is operating, but collectively, over 100 members are running their own public portfolio. So I'm really excited about this because it gives a lot more context for all our members out there, and it's ultimately our goal to have every member of ShareWorld Systems become part of this community and run a version of their own public portfolio. And we're going to be running these Learn to Trade properly courses over each month, starting every sort of around about 6 weekly throughout the course of the year. And so the idea is that not only do we have public portfolios, but we have Learn to Trade portfolios, both on the Australian market and the US market, which are just other sources of experience and proof of an edge manifesting into those portfolios over many years to come. So I think that's, there's a lot of merit in doing that. And the experience so far from those members that have been in those groups is that they're really enjoying it and being part of a community and feeling connected to a live portfolio rather than I feel very connected to the public portfolios and I love them. And Gary is the person who's running those. So we get to see, a highly skilled investor trade those portfolios. And now with the Learn to Trade portfolios, we're getting more and more skilled members being able to showcase their portfolio in these sessions. So.
Couple of things to add to that. Dave left out the P. What does the P stand for?
Oh, properly. So learn to trade properly. So, and that's what the course is all about. So, what is it that differentiates, the 95% of traders who aren't successful? What is it that they're doing that is not proper? And so we really focus in on that.
And we got the word properly from Mark Douglas, but he doesn't use that word in his book Trading in the Zone. He used it in his Path to Consistency workshop, and that's where I got it from. And he talks about the difference between analysis. There is a big difference between analysis and trading, and the one is analyzing without money at stake. But then when it comes to executing, that's when you are under the pressure of having money at stake. And it's about executing properly. Trading properly is what this whole game is about. And you're only trading properly when you are flawlessly executing your edge under the pressure of having real money at stake. And that's what Learn to Trade Properly is all about, is to take our members and we're creating cohorts or groups, if you like, collectives, communities of people that are, and this is the key bit, is that everybody is in the same trades at the same time. So that each cohort has exactly the same trades and has the same portfolio. Only difference is that people choose how much money they do it with, depending on where they are in the journey and how much they're prepared to put at stake. And it's got to be enough that it means something, that you're going to be tested, to potentially not be consistent, not be objective, not trust, and not have confidence, but not too much that you just can't handle the risk. And that is how we learn to trade properly, is that you slowly go through this experiential learning of executing under pressure with enough money at stake to test you. And then to, as we spoke about, and the people who have done the process and mindset training intensive is with the skills acquisition plan, is that you continue to do that, executing flawlessly while you are in the discomfort zone of being in drawdown, and then coming out of that and then feeling what that's like, experiencing what that's like. And then, as with most things in life, it's never as bad as you thought it would be. And obviously, as you get more proficient at handling discomfort, you become comfortable with being uncomfortable, which means that, sorry, it's not speak off, which means that you are able to learn to trade properly under pressure. So that's what it's all about. And I think, thanks, Bruce. We'll come to the comments in a moment. So there's that one. There's that portfolio.
There's that one. And we've just started a new one on December the 9th. So Learn to Trade Properly for the US. So I was just thinking about what you were saying there with Mark Douglas and the book Trading in the Zone. And that's one of the key objectives through Learn to Trade Properly, is that if we can take on the learnings of Mark Douglas and James Clear in particular, and create what we call a new identity, then we are learning how to trade in the zone. And so really Mark's book, if we are able to learn how to trade in the zone, then we are learning how to trade properly. So we could have given Mark Douglas's book a new title. We could have called it Learn to Trade Properly. How? By learning to trade in the zone. And that's where, in particular, James Clear, all his great works, really helps with that. So I've got two groups, and we're going to start another one in February the 3rd, my birthday. So I'd like to have as many members there as possible, those that would like to join. That's with an ASX portfolio, but it won't matter. If you wanted to trade US on that particular date, there's absolutely no reason why you couldn't start a US portfolio as part of that group, and then we just look at two markets.
Correct.
Yeah,
correct. Learn to trade properly, and you could do both if you wanted to. Yeah. But the point is that these two are separate ones, ASX, ones US. But on the 3rd of February, there's going to be both going on simultaneously. Right. Let's move on to look at the actual portfolio. So the first one here is this is the sells over the last month since we did the last one of these portfolio consideration session. And the Australian public portfolio, the ASX public portfolios, only had one sell, BlueScope, and that was above that 10%. So they're starting to get into what I would call a stumble. Anything above 10% is a bit of a stumble. Only lasted 38 days. In the US, we've had two, one small profit, one small loss. And in the leverage portfolio, the same. And the reason that there's a slight difference in the actual net profit percent there is due to basically different position size with different brokerage. And sales over the last month in the LTTP, Learn to Trade Properly ASX, was started in September, which is fully invested. Is it not?
It was up until a couple of days ago. Yeah. We've had a couple of sells, so we've got 7 positions out of 9 there. BlueScope, again, that was in both portfolios, so the public portfolio and also the September group portfolio. So as you mentioned, a little bit higher than normal. Going through, having a look statistically, the edge over a big sample size, average losses tend to be around that 6-7%. So it's a little bit bigger than that. But what do we think of that? Again, using our no expectations or any preconceived ideas about any of the outcomes. It is what it is, and it's in the ballpark of things, and it's nothing to worry about. So and the other one there, a small win on car sales. I wouldn't call that a leap by any stretch of the imagination. And as you mentioned before there, FLT, a small loss there, and BSL around about normal.
This is for since inception. Those are the 4 sales since inception, rather than the last month, because we've just started on that one. And we look at the US portfolio. So let's have a look at performance now. As we've done before, we look at open trades and periodical metrics going back over a few years. Have a look at the equity curve. So to do that, going to switch into Beyond Charts, and we'll go straight into the ASX portfolio. Yep, this is ASX portfolio. So this is since inception, which is coming on for nearly 9 years in about 2 weeks' time. And we're running at just about 2.5%, a little bit more compounded percentage points better than the the ASX 200 index. Look at a couple other things over here. Win rate is a little bit lower than what we would expect. That should be probably closer to 45%, mid to high 40s. But the payoff ratio is round about where it is in research. And that gives us an expectancy of 0.36, also a little bit lower. And what we've seen is these numbers come down over the last 3.5 years, when the ASX has basically been in one big sideways moving market. Of course, the All Ords accumulation index, or the ASX 200 accumulation index, has risen because of dividends, and about half of the growth in Australian indices comes from dividends, whereas about 20% comes from dividends in the US. So what else we got here? There's a Sharpe ratio. It's quite healthy at 0.8, and that's just because drawdowns are lower relative to compounded growth. So we'll have a look at where we're at the moment. We've got one vacant position, and what does the equity curve look like? Well, what I've got here is, and I just keep this for my own edification, relative strength between the accumulation index and the portfolio. And you can see times of outperformance and underperformance here, but certainly in a sideways moving market, we can see relatively the ASX 200 accumulation index has been outperforming the actual portfolio. But this bottom line is which is really where you get direction from, is from the All or the ASX 200, I think, and which is just the cash index, no dividends involved there. And you can see there's a bit more similarity between the portfolio equity curve and the ASX 200 cash index. So what we'll do now, and what I've done before, is we'll go back and look at some periods. So I'm going to do 1, 3, and 6. We've done inception. So we'll go back to, and you can do this yourself, no problem. To go to 12, and we'll look at. So we're going to look at the last year, and whoops, so we just got to go to statistics. So what we're seeing here over the last year, 13% versus 15.6, so about what 2.7 or something like that percent difference in the year. What have we done? We've had pretty low win rate and a payoff ratio of 2.6 and a expectancy of 0.23. So relatively low, but still got a gain there. Now I'm going to go back 3 years, so 2021, and have a look at performance there. So this is where this 3-year period that I spoke about of sideways movement, trend following systems struggle in sideways, quite wide ranging. And we saw that on the initial chart. And you'll see the difference in a moment between the ASX public portfolio and the US public portfolio, where there's been a lot more trend. So underperformance there, compounded wise. And I know that frustrates people, and that's why learn to trade properly is all about. It's about being in that discomfort zone and being able to stick around. Sure, there's underperformance, but it's not loss. And stick around so you can be there for the big moves. And so many people kid themselves that they'll take a breather, but when the market starts moving again, I'll get in then. Yeah. Of course, they're not in the process. They're not thinking about it. They're not vigilant. And boom, and they get in way too late. Typically, they need a lot more proof to get back in. And that proof comes like in the US market after we've seen a 20-30% move, and they start waking up and it's too late.
Yeah. And Smooth C's never made a competent sailor, and the past 3 years has been the perfect time to learn how to trade properly and hone those skills. So those of you that have been members over the last 2-3 years have had an environment that if you've been able to survive that particular environment, well, look, you're well on the way to becoming, that much more finely tuned trader in this particular sense, or sailor, being able to navigate those seas. So when the smooth times comes, you're there. You're out on the water. Absolutely. You haven't packed up the boat and gone home.
Yeah. And that's when the pleasure and the joy comes. But the challenge of this is being able to is getting to a mindset where pleasure and joy come from the process rather than being fixated on outcomes, because nobody can predict when anything's going to happen in the market. You can certainly make a big prediction, like if I invest for 30 years, I'll make a profit, and that's just going back over many decades, even hundreds of years, and running rolling 30-year periods, and every 30-year period you would have made a profit, just a tiny one, but you would have. That's about the only thing you can predict in the markets. The rest is really about process and mindset. Yeah. Okay, we'll look at the last 6 years, and you can see over the last 6-year period, 136, is that there's outperformance by the ASX public portfolio of the market by quite some time. Why? Because that's now including the big run-up, the big trend that happened in 2019 into 2020, and then also this back half of 2020 as well. And that's what we live for. That's what we stick around. We survive to thrive. What are we surviving? When you've got an edge, it's really surviving your discomfort. That's really what you got to survive. And that's in the mind. And if you can survive discomfort, then you'll thrive to be there for profit.
Absolutely. And those of you who cast your mind back 2018, that was a pretty bearish year. We had the market was down nearly 20% come Christmas time. And we didn't know what on earth was going to happen next. Yeah. And I think the point that you just made before, Gary, about your investing horizon is really important. Thinking about that, if you come in with a short-term point of view that I'm only going to invest for 2 or 3 years, then there's going to be all sorts of things that can have an impact. But over the long term, we know that markets rise, that they have survivorship bias, and we need to be pragmatic and very objective about our investing horizon. And that just comes back to, if you're about to pull up stumps from work and retire, that doesn't mean you retire from investing. Your investing horizon is going to be many years, 10, 15, 20, potentially 30 years beyond that. So a window of 3 years is really quite insignificant during that time frame.
Absolutely. Okay, moving to the US market now. We're going to do the same. We're going to do 1 year, which is that's going back to December last year, and so this is the US public portfolio using Sparsry Investor, and here we've got outperformance. Okay, 32.39% by the portfolio, 29.72 by the S&P 500 total return index. So let's have a look at some of the stats over the last year. We've got a win rate of 55% and payoff ratio of 2.6. Payoff ratio, the average winner is 2.6 times bigger than the average loser, and the combination of those two go into the calculation of expectancy, which is 1, which is a really good expectancy, and it's no wonder that we're doing well. And you get through the tough times, the discomfort zone, to be able to stick around for these times. And so that's been really good. Let's go back to 2021 and see how we've done here. Now this includes 2022, which was a bear market, and you can see how the win rate drops to 40%, payoff ratio 2.1, expectancy now down to 0.26, and about 1.4% underperformance from a CAGR or annualized return point of view there of the ASX, of the US public portfolio versus. And if you look at the last 2 years, it's also been outperformance, but we're looking at 1, 3, and 6. So let's go down back to 2018. I messed that up. Okay, and so here about 2.7% compounded behind the S&P 500, which by the way, looking at SPIVA scorecards and persistent reports, if you haven't looked at SPIVA, SPIVA, that about 93% of mutual funds in the United States right across the board underperform the S&P 500 total return index. So it's had a really good run over that time. So we're within Kuya that, and I would expect that we do outperform it at some stage, and we'll see what market conditions come to do that. There you can look at the win rate, also the an expectancy running at 0.44, which is what we'd expect in live environments, and we'd hopefully get a little bit higher than that over the long term. And now we're talking about 287 trades over the last 6 years. So these sample sizes are getting to be pretty decent. Now I've gone back to inception, and within Kui we got to very close to actually outperforming the S&P 500, as you'll see over here in the chart. There's 2022, which the portfolio or the methodology struggled with, and you can see the underperformance in that period of time, then outperformance, a little bit of underperformance, and then outperformance again as well. So it's getting through, surviving these periods so you can get these periods. That's what it's all about. Quickly looking at leverage. Okay, leverage we've got since inception. It's in the green but underperforming. But what we're going to do is go to 2023, and I'm going to go to 12 there and 17 there. See how leverage is done. So over the last year with leverage, we've doubled. The portfolio has doubled compared to the market rising 30%, but the accumulation or the total return index rising 30%. What's the win rate been? 59%, 2.66 payoff ratio, expectancy 1.18. And what did we do? We did 47 trades, and that includes the open positions over that period of time. More trades in the leverage portfolio because we got more open positions. We got 15, and we're also using this new parameter which we introduced just over 2 years ago called position risk. I'm not going to talk about it now. You're going to hear a lot more about it in the new year, so we'll leave it at that. Let's just go back to, and I'll just do 2022. We'll do the last 2 years here just to see what how this portfolio has gone. So it's at 84% compounded over the last 2 years compared to the index. So some nearly 3.5 times more outperformance, which you can do with leverage. But any of you who've watched the webinar that I did last week, I kind of went into a bit more detail about this portfolio and really focusing at this period over here, where there's been 408% growth compared to 72.4 in the S&P 500. But our research over the last year or so has been, in a leveraged environment, how do we reduce this drawdown here, which obviously got magnified in that period of time. And the one of the secrets, and we're doing more research, so stand by and watch this, is this little thing that we've introduced here called position risk. So more on that to come. Right, onto the LTTP, that the ASX one. Maybe Dave can talk to this one.
Yeah, so I mean, we've just had a look at those broader windows, those equity curves that have been over many, many years. So, you know, that's the 10,000 foot view. Here we're really zooming in on what effectively has been only a couple of months since 20th of September.
2.5 months. Yeah.
2.5 months. So we're looking through a tiny window at this point in time, and you know, it's a little bit like the worms on election night, isn't it? You know, we're just having a bit of a fight between the two. So, you know, there's not a lot of meaning that we can have, you know, that we can attach to this at this point in time. We know that anything can happen, but all it's doing at this point in time, as the positions show here, when we looked at some of those closed trades before, you would look at that and think, oh, that portfolio can't be doing very well because they were closed trades. But when we actually go in and see the live trades, we can see that there's a variety of stocks there, and that those positions, those trades, they're still open positions. So when we think about that, we've got a portfolio that's currently only holding seven positions. We've got to sit there and wait, you know, follow our process, wait until the next signals come up. And so we're just waiting patiently, nothing to do in between times, and looking for either new entry signals, or in case we have to exit, any exit signals.
Yeah, and so that's the annualized return, which is just really, if it's less than 1 year, there's no annualizing that takes place, no compounding takes place. So a little bit of outperformance to start with.
One thing I'd like to point out there at the moment with this particular portfolio, and this is a skills acquisition portfolio, and one of the objectives is for us to be able to trade through multiple 10+% periods of drawdown, ideally 15%, even maybe 20%, to really test and hone our skills. So our maximum drawdown that we've had at the moment is only 4%, and we're at this particular point in time, if you can see the current drawdown, it says we're at -3.12. So we're in a little bit of the drawdown. That just means we're just that little bit behind our all-time high. Okay, so we have to put this in, give it some context, and think, okay, we're sailing our boat, and we've had a few ripples on the waves, but we haven't yet had any really big storm. So, you know, we've got to be prepared for that and expect it, and look forward to the opportunity to test our skills.
To embrace it, look forward to it, and go, right, I want to get through those 10% drawdowns because I want to be tested. Why do I want to be tested? So I can grow, because we only grow in times of adversity. We don't grow, you know, we don't learn to be a good sailor in sea state 1 when the ocean's flat. We need adversity to test us, and that's what the skills, and this is nothing new. We've only applied it to our skills acquisition plan, and we're doing, you know, that's what we actually are enacting with real money, everybody with their own real money in the Learn to Trade Properly, so we can take them through that. Just we can play a major role in helping you go through discomfort, becoming comfortable with discomfort, and that's what it's all about. So now, hopefully, all of the cohort, the people in this one that started on 20th of September, are looking forward to a 10% drawdown, so they can test themselves. And another thing I think that we should point out here is the amount of money being used. Dave started this with, what was it, 30?
I think it was $30,000.
$30,000, yeah. Okay. And whereas everybody in the cohort would have different amounts of money, based on what I said earlier, you know, enough to test you, but not too big that it, you know, takes you out of the game, out of the process. Okay, that's more or less, that's all we want. Oh, the US one is only, we'll look at that quickly. It's only got one position in it so far, and it's sitting in a wee bit of profit. So, and it's very early days. That's what the equity curve looks like. And in time, we'll follow these, and we'll see how the worm travels, and how we live through and experience, you know, the ups and downs of managing a portfolio in this way, trading properly, as Mark Douglas said. Right, there's one question. Do you want to answer that one for Bruce?
So the question, are all LTTD members executing at market on close or a range of times during the day. So it depends a little bit. In the US market, most of the members are trading market on close. Now, how do you do that? Well, you need a specific platform that's going to allow you to do that. The Saxo-based platform does allow you to place a market on close order automatically. Those of you that don't have a platform that allows that, it just means for the US, you need to be up early in the mornings to place those trades as close as possible to the end of the day. In the Australian market, again, it depends a little bit on your time commitments during the course of the day. Some platforms, again, will allow you to trade that automatically, market on close. But if you don't have a platform that allows that, then, what can you do? You could set a reminder on your watch, on your phone or whatever, to say, look, it's 3:45. I better get active and make sure I place this particular trade. Those of you that got commitments that time of the day, then if you have to do it at lunchtime or you have to do it in the morning, the important thing is to stick to your process. Make it as easy as possible to do something that you can commit to, every moment when you need to. So, keep in mind this, you're not trading every single day of the year, but it is important that you get those trades filled at some point during the day. In the US market, it is much more important to be placing close to the market's close as possible. In the Australian market, it is still better, but it's not as significant as in the US, Gary.
And in terms of brokers, Interactive Brokers and Saxo are two of the US brokers, or access to US markets, where there is market and close. There are market and close orders. Whereas I think Self Wealth doesn't have it. I've spoken to them a couple of times and said when they've asked for feedback, and I do know a couple of people in there by phone that said market on close orders, both Australia and US. But obviously they don't, and I don't think there's any other Australian other than Saxo or the ASX market. I think I don't think Interactive Brokers have a market on close order for the ASX, but they do obviously for the US, and most US brokers have market on close orders. But you typically, if you're trading through a super fund, it's going to be very difficult if you don't already have a super fund account offshore, the US broker, to open one. But if you're trading in under some other entity, a business or a PTY Limited or your own name, you would typically be able to get access to a US broker, offshore in the US, and there are market and close orders there, but that takes some time to set up. Yeah.
And probably the last thing, Gary, is if any members that are watching today, either live or the recording, we are running in the beginning of February a new Learn to Trade Properly members cohort. And we'll be running them throughout the course of the year. So if you see any emails popping out your way inviting you to come along and you'd like to be part of it, please just reply to those emails, or you can send a personal email into support on my email address and just let us know that you want to be part of that group, and then we'll get things organised behind the scene so that you can start and do any pre-work that's required, because there is some pre-work required before those official dates kick off.
Right, we'll finish there. Thank you, Wayne, for your note to us, for your thanks, and that it's been a good year and the hard work put in, but also same to you and all others watching. Have a great Christmas and New Year, and we'll be back highly invigorated after a break, and look forward to following these portfolios through the course of next year. As always, wish you consistent and objective and peaceful active investing and trading.